you go out here 10 years, and at 10 years you can get 0.1% more interest than you can get at 9 years. Does it really make sense to tie your money up for that extra 0.1% when interest rates could go up and leaving you holding an investment that's yielding an inferior amount? So that's how yield curve looks and how it steepens at these shorter maturities. Another important point is this: a lot of times people approach their bond investments in this way right here. You buy a bond, it's a good quality bond, and you say, oh, that's it, I got it, and that's how it's going to stay, and it's all good, I don't have to worry about it. Well, that really isn't true. There are things that happen over time. Ratings can change. We talked about the U.S. government debt being downgraded a year and a half ago, but that happens fairly regularly, and a lot more so these days than it used to happen. We've actually seen situations where ratings deteriorated and no one was paying attention, and the value of the bond was basically completely gone. Went from $20,000 down to virtually nothing, and the insurance company didn't realize it until it was valued at nothing. The reason for that is no one was watching it. The manager wasn't watching it. The board of directors weren't really paying attention to it. And understand that if you're working with a broker, they have no reason to continue to monitor that investment. They've sold it to you. They've made their money on that deal, so there's really no reason for them to continue to monitor it. So these ratings change, but sometimes there's nobody watching over that stuff, and that's how that kind of thing can happen. Offers are made on bonds that need to be evaluated. As I said earlier, we've seen an unprecedented level of activity in that regard just recently, but it does come up quite frequently. We just had a case here a few weeks ago where we had a $20,000 bond for an insurance client that was going to come due in December of this year, and the issuer came along and offered us an exchange in some common stock that if we turned around and sold the common stock was going to get us $30,000 for this $20,000 bond. And this wasn't an obligation, wasn't a call, it was just a redemption offer. We looked at that and said, by gosh, that's a pretty darn good deal. Convert our $20,000 investment with 10 months to go yet into a $30,000 investment, and so we accepted that offer on their behalf. But these things come along and they need to be evaluated. You can't have your head in the sand about opportunities that arise. And then the market may present opportunities to change the taxability of your or the maturity of the portfolio, and that needs to be evaluated. We've seen quite a bit of activity in that regard over the last year to 18 months as interest rates have fallen off the cliff. Values of these longer-term bonds are at a high point with interest rates being so low, and so it's an ideal time to look at selling those longer-term bonds, converting them either into something much shorter so that you've captured that high value and now you've got an investment that's going to come due much sooner in case rates do go up, which we think they are going to go up eventually, or perhaps change the taxability. If you're being taxed on your total earnings, including underwriting income, and you've had a few bad underwriting years, maybe you don't need municipal bonds anymore in your portfolio, so it's an ideal time to cash out of the ones that you do have, capture maximum value in them, and then turn around and invest in a taxable bond because you've got some losses to shield the net interest earnings from taxes for a period of time. I also wanted to mention briefly about custody issues.